Welcome back to the Deep Dive, where we take your source material articles, research your own notes, and really unpack the most valuable insights. Think of it as your shortcut to being truly well-informed.
And today we're diving deep, really deep, into a cornerstone of investing wisdom. We've got excerpts from Benjamin Graham's legendary book, The Intelligent Investor, and some pretty insightful commentary that helps bring those timeless principles into today's world.
Yeah, our mission is clear. Cut through all the noise, extract the core principles, the strategies that have, really stood the test of time, and the crucial warnings Graham laid out. Specifically for individual investors like you, we want to get at what it really means to be intelligent when you're navigating the markets.
Get ready for, well, a journey through some fundamental wisdom, stuff that holds true across decades. We'll see some surprising historical parallels, too, things that echo today, and hopefully some clear, actionable tools you can actually use.
To build a better approach to stocks and bonds.
Exactly. Because Graham's work, it's a powerful counter-narrative to so much of what, frankly, Wall Street pushes.
Right, and that's kind of where we need to start, isn't it? Graham doesn't jump straight into, PE ratios or market caps. He starts by defining the intelligent investor. And it's not really about being the smartest person in the room.
No, absolutely not. That's the key insight right there. Graham argues this kind of intelligence, well, it has almost nothing to do with your IQ or academic background. It's fundamentally about character.
Character. In investing, how does that work?
Well, he points to traits like patience, discipline, strict discipline, really a genuine eagerness to learn, and maybe most importantly, the ability to harness your own emotions and to think independently, against the crowd.
Right.
He actually writes that this is a trait more of the character than of the brain.
That's fascinating. It completely shifts the focus, doesn't it? Away from just external market stuff to, internal self-control.
Exactly.
So how does this intelligent approach, how does it contrast with the kind of activity Graham saw? And let's be honest, we still see constantly on Wall Street.
He contrasts it very sharply with speculation. Speculation, for Graham, it's relying on luck, trying to time the market. And too often, it just ends up making money for the brokers who are facilitating all the trades, not really for the speculator themselves.
And Wall Street's role in promoting that.
Well, Graham observed that Wall Street almost inherently downplays those durable virtues, patient, disciplined investing. They're always hyping the quick gains, the excitement of speculation.
It appeals to that quick, rich desire.
It does, that human desire for rapid wealth. And that's exactly what the intelligent investor has to learn to control.
He had that memorable line comparing the market to a casino.
Yes, he calls investing a unique kind of casino. But here's the twist. Unlike a regular casino where the odds always favor the house, Graham argues that if you strictly stick to certain rules, the rules of intelligent investing, you basically cannot lose in the end.
Really? Cannot lose.
That's his argument. The intelligent investor bends the odds in their favor. The speculator, they're often just, contributing to the house's take.
Okay, so that brings us right to that fundamental line Graham draws. Investment versus speculation. It sounds simple, but clearly it's a line that gets blurred a lot.
It does, and often to your detriment if you confuse the two. Graham's definition, implicitly, investment is an operation that, first, involves thorough analysis, and second, promises safety of principal and a satisfactory return.
And speculation.
Speculation just lacks those characteristics. It's more about betting on price moves, not really owning a piece of value.
He learned this distinction the hard way, didn't he? Pretty early in his career.
Oh, yeah. A brutal lesson. He talked about his experience back in 1919 with a company called Seavold Tire. It was a new offering. Hot sector automobiles. He saw the stock jump 250% on the very first day.
Wow, that sounds like an investor's dream start.
It sounded like it.
Oh.
Except by October of that same year, the company was exposed as a total fraud. And the stock, completely worthless. That's the Savold Tire experience in a nutshell. The thrill, the quick gain, followed by total wipeout.
And it's kind of chilling how that exact pattern just repeated itself decades later with the whole internet boom and bust.
Absolutely chilling. The commentary draws those direct parallels. You had funds like, the Monument Internet Fund, shrinking from $10,000 down to maybe $2,000 in just over 2 years.
Ouch.
Yeah. Famous stock picks losing 94% of their value. Stocks like Juno just shriveling up to almost nothing.
And the quotes from the market gurus back then, just dismissing fundamental value, it's almost unbelievable looking back.
It really shows that speculative mindset completely taking over. You had people saying things like, it's not a mania, or look at the absolute value of the growth. or dismissing companies for being too high was the worst mistake an investor can make. They were explicitly rejecting Graham's core ideas.
Rejecting the basic idea that the price you pay actually matters.
Exactly. And Graham's warning just hangs heavy over that whole period. Enthusiasm on Wall Street almost invariably leads to disaster. It just seems to be a historical constant.
It feels like the system itself kind of encourages this short-term emotional roller coaster.
It often does. And that's why Graham says that phrase you sometimes hear, reckless investors. It's just a laughable contradiction in terms.
Like spendthrift misers.
Exactly. The words just negate each other. Recklessness and true investing, they just can't coexist in his view.
Okay, that really sets the stage. We understand the mindset needed, the danger of confusing investment with speculation. Let's get down to the bedrock. What are Graham's core principles for someone who's committed to being truly intelligent in the market?
Right. Well, the absolute central concept, the one idea that really underpins everything else, is the margin of safety.
The margin of safety. Okay, how does Graham define that, and why is it so incredibly critical?
At its simplest, you can think of it as the difference between a stock's earnings yield when you buy it.
Earnings yield. Just quickly, that's like the inverse of the PE ratio, right?
Yeah.
Earnings divided by price.
Exactly. So the difference between that earnings yield and the interest rate you could get from a safe bond. Graham noted back in '72, there was hardly any margin, maybe even a negative margin compared to bonds, whereas in '65 it was substantial.
So if bonds yield, say, 5%, and the stock's earnings yield is only 3% at its current price, you've got no cushion there compared to the safe option.
Precisely. But the concept, it goes deeper than just that comparison. It really means buying any asset, stock, or bond at a price significantly below its estimated intrinsic value, its real worth.
Finding those 60-cent dollars.
That's the idea. You want that buffer, that margin, to protect you. Protect you against errors you might make in your analysis, against temporary market downturns, against just plain bad luck or unforeseen bad news for the company. It's basically your insurance policy against the uncertainty of the future.
It sounds like a fundamentally defensive approach baked right into the purchase price.
It is. It's Graham's core mechanism for ensuring that safety of principle. Now, closely linked to this is his view on trying to forecast things.
Predicting where the market's going.
Yeah. Graham is just unequivocal on this. Predicting market movements, whether it's stocks or bonds, is virtually impossible. Sometimes he even said completely impossible.
So the intelligent investor just doesn't waste time trying to time the market highs and lows.
Exactly. Your strategy isn't built on guessing the next crash or the next boom. It's built on understanding the value and demanding that margin of safety.
But the market price is right there, every single day, bouncing all over the place. That's got to be hard to ignore.
It is hard. And that's where his third principle comes in. Price fluctuations is opportunity. Graham argues those daily quotes from the market, his famous allegory of Mr. Market knocking on your door.
Right, offering to buy or sell shares every day.
Yeah, those prices are there to be taken advantage of. So, buying wisely when prices fall sharply, selling wisely when they advance greatly, or, and this is key, simply ignored.
Ignored? Like, just pretend the stock ticker doesn't exist.
Pretty much. He goes so far as to say the investor would often be better off if his stocks had no market quotation at all.
Why?
Because without those constant, often irrational updates from Mr. Market, he'd be spared the, quote, mental anguish caused him by other person's mistakes of judgment. You don't let the crowd's panic or their euphoria dictate your rational decisions about your own investments.
Wow, that is a profound shift in mindset. It's not about reacting to the market. It's about using the market's craziness to your advantage or just tuning it out completely.
Precisely. Which naturally leads to the fourth principle. Think like an owner. Graham insists you should treat owning stock not like it's just a piece of paper to trade back and forth.
A lottery ticket.
Right, but like you literally own a proportional piece of a private business.
Okay, so how does viewing it that way actually change your approach? What do you do differently?
It means you evaluate the business itself, just like you would if you were considering buying the whole company outright. You look at management efficiency. How do they stack up against competitors in profitability, size, market position? You scrutinize how management treats the outside shareholders, like you. You demand clear financials. You look past the headline numbers for any signs of obfuscation, like those cost management keeps calling non-recurring. But somehow they seem to recur quarter after quarter.
Like Micron's inventory write-downs he mentioned.
That's a classic example. You actually read the proxy statements. You become wary of managers who don't seem to think and act like owners themselves.
So it's not buying a stock, it's buying a business that happens to have a stock certificate attached.
That's a great way to put it. Exactly. And finally, principle number 5, to manage the uncertainties that exist, even with the best analysis. Graham stresses diversification.
Spreading your risk around.
Yes, it's essential to minimize the impact if one investment goes bad, but it also serves another crucial purpose. It maximizes your chances of capturing those unexpected huge gains from the occasional super stocks that emerge over time.
Like Southwest Airlines or Dollar General, which nobody could have predicted way back when.
Exactly. Impossible to pick them out in advance with certainty. So a diversified list, Graham suggested maybe 20 or more stocks each bought with that crucial margin of safety, vastly increases the probability that your overall portfolio result will be favorable. You protect against individual failures while making sure you participate in potential big successes.
Okay, great. So we have the mindset, the core principles, that fundamental investment versus speculation divide. Now, Graham also recognized that not everyone has the same amount of time or maybe the inclination for super deep analysis. So he outlined different strategies for different types of intelligent investors. Let's start with the defensive investor.
Right. This is the investor whose main priorities are safety and simplicity, above all else. Their goal isn't to shoot for the moon. It's about getting satisfactory, reliable results with minimal fuss and worry.
And how would they typically structure their investments, according to Graham?
Well, historically, Graham suggested a basic split between high-grade bonds and stocks, maybe around 50-50 as a default. He did allow for some variation, maybe shifting towards bonds if the market seemed high, or towards stocks if it seemed low. But he was generally skeptical about the defensive investor's ability to time the market successfully. In fact, he specifically counseled against having more than 50% in stocks back in the highly valued market of early 1972 when he was revising the book.
Got it. So what kind of bonds are we talking about for this defensive approach? Only the safest.
Pretty much. High-grade corporate bonds, think AAA with A or A ratings, or municipal bonds, depending on your tax situation.
No.
U.S. savings bonds were a classic example he used in the past, but he strongly advised against buying second-grade bonds at par.
Meaning lower quality bonds bought at their full face value.
Right. If you're going to take on the extra risk of lower quality, Graham insisted you must buy them at a significant discount, maybe 70 cents on the dollar, maybe less to give yourself that essential margin of safety.
Makes sense. And the stock portion for the defensive investor, what does that look like?
The universe gets narrowed down quite a bit. It's limited to large, prominent companies that are conservatively financed. They should have a long, uninterrupted history of paying dividends.
Any specific financial tests?
Yeah, he even provided a quantitative filter. The book value of the common stock should be at least 50% of the company's total capitalization for industrial companies. For utilities or railroads, it was a bit lower, maybe 30%.
Okay, that's a pretty clear rule. Are there simple ways for the defensive investor to actually implement this without becoming a stock-picking expert?
Absolutely. One primary method is investing through well-established, diversified funds. Mutual funds are the obvious choice today. He also mentioned common trust funds or even closed-end funds, which sometimes trade at a discount to the value of their underlying assets, potentially offering a kind of built-in margin of safety.
And the other key simple method?
Dollar cost averaging.
Ah, yes, investing a fixed amount of money at regular intervals, like every month, no matter what the price is doing.
Exactly. It takes the emotion and the guesswork out of the equation. Because you invest consistently, you automatically end up buying more shares when prices are low and fewer shares when prices are high.
Right.
Over time, this leads to a satisfactory average cost per share. You achieve solid results without needing to be a market timer or a brilliant stock picker. As Graham liked to put it for the defensive investor, often just sitting still wins the race. Keep it simple, keep it consistent.
Okay, what about growth stocks? Everyone seems to want growth, but Graham seemed pretty cautious about them, at least for the defensive investor.
Very cautious, yeah. He generally viewed growth stocks as too uncertain and risky for the defensive profile. The main reason, they often trade at really high valuations compared to their current or even past earnings.
So you're paying a big premium for expected future growth.
Exactly. And if that rapid growth slows down, or if the company hits unexpected problems, think about IBM, Texas Instruments, Microsoft, Cisco, at various points in their history. The stock price can get absolutely hammered because it started from such a high valuation.
So even if the growth prospects look obvious.
Obvious growth prospects don't guarantee obvious investor profits if everyone already knows about them and has bid the price up to the moon. The expectation is already baked in, and then some.
Okay, so safety, simplicity, consistency key for the defensive type. What about the enterprising investor? This is someone who's willing to put in more work, right?
Correct. This investor is willing and able to devote considerably more time and effort to research and analysis. They're looking for potentially higher returns than the defensive investor, but they understand it requires more skill and diligence.
So what kinds of activities are considered acceptable or maybe even necessary for them?
Well, they might attempt to buy low and sell high based on market fluctuations, although Graham constantly stresses how difficult this is to do consistently well. They can look at carefully chosen growth stocks, but, and this is a huge caveat with the strong warning against paying too high a price relative to earnings.
Still focused on value, even with growth?
Absolutely. They can also pursue what Graham called bargain issues and special situations.
Bargain issues. That sounds really intriguing. What did Graham mean by that specifically?
This was one of his more famous quantitative strategies. He looked for common stocks that were selling for less than their net working capital alone, after subtracting all prior obligations like debt and preferred stock.
Net working capital. Just remind us quickly.
Sure. Think of it as the company's current assets, cash, receivables, inventory minus its current liabilities, basically its short-term debts. So Graham was searching for companies where the stock market valued the entire company at less than the value of its easily sellable assets minus its immediate bills.
Meaning you were essentially getting the factories, the land, the buildings, the goodwill for free.
Exactly. You were buying the liquid assets for less than they were worth and getting the rest of the business thrown in. He found historically that buying a diversified basket of these neglected, often friendless stocks could yield excellent results.
Wow. That's a clear bargain if you can find it. And special situations, what falls under that?
These were more complex scenarios, things like trying to profit from arbitrages like risk arbitrage in mergers or liquidations or corporate reorganizations.
Sure.
While these were profitable areas historically, Graham noted even by the 1970s, they'd become much more competitive and required specialized knowledge and carried significant risks.
So maybe less accessible now.
Potentially. Perhaps analyzing and investing in lower quality or distressed bonds bought at steep discounts might be a modern equivalent that falls into this enterprising category.
Going back to growth stocks for this enterprising investor, if they're supposed to avoid paying high prices, how do they analyze them effectively? What's the approach?
Graham recommended applying more rigorous analysis than the defensive investor, definitely. But he maintained a heavy dose of skepticism towards complex, long-term forecasts. He felt that calculating a value based on past performance, using a multi-year average of actual past earnings, was far more dependable and realistic than relying on elaborate projections of future growth decades out.
He warned against fancy math.
Yeah, he warned that complex mathematical models were often just used to dress up speculation and make it look like sophisticated investment. Keep it grounded in reality.
What kind of specific financial analysis should the enterprising investor really be digging into then? Beyond the basics.
You absolutely have to look deeper than the headline numbers. Scrutinize the cash flow situation very carefully. Graham warned against what he called OPM addiction.
OPM.
Other people's money. It's when companies rely heavily on constant borrowing or continually selling new stock just to keep the lights on, masking fundamental weakness in the actual business operations.
We saw that with some big flameouts, right? Like Global Crossing, WorldCom.
Textbook examples.
Yeah.
You also need to analyze the true earnings picture, which can often be obscured by accounting choices. He used the example of the Northern Pacific Railway, where complex railroad accounting rules made it very hard to see the real underlying earning power of the business without digging deep.
So spotting those accounting games is a major skill for the enterprising investor.
Absolutely crucial. You need to learn to spot them. Look for companies that repeatedly take special charges that sound like one-time events but seem to happen every year. Pay close attention to changes in how they calculate depreciation or how they value inventory using FIFO versus LIFO.
First in, first out versus last in, first out.
Right, different accounting methods that can significantly impact reported profits, especially during inflationary times. And you have to understand the potential dilution from things like convertible securities or stock warrants that could eventually turn into more common stock, reducing your ownership share.
Graham also had some pretty strong opinions on certain corporate actions that management might take.
Oh, yeah. He was quite critical of management using stock splits, for instance. He suggested it often treated investors like bilts using that analogy that giving someone 2 nickels for a dime doesn't actually make them richer.
It doesn't change the value, just the number of pieces.
Exactly. But it can create speculative hype. He mentioned the Exodus Communications example where news of stock splits seemed to artificially boost the price, disconnected from fundamentals. He also frequently highlighted the destruction of shareholder value through ill-conceived acquisitions, often referring to the winner's curse, where the company buying another business typically overpays.
So where should these enterprising investors who are doing all this work look for information or advice? Can they trust anyone?
Well, sources can include friends, bankers, brokers, specialized financial services, investment counselors, all the usual suspects. However, the absolutely crucial element, the non-negotiable part, is developing and consistently applying your own independent judgment.
You can't just outsource the thinking.
No. Graham believed the enterprising investor must be competent enough to critically evaluate any advice they receive. Financial services often provide forecasts simply because there's a market demand for them, not because they actually possess a reliable crystal ball. Brokerage research needs to be viewed with a skeptical eye.
Did he offer any guidance on choosing an advisor?
He did. He suggested asking key questions before hiring someone, like how they define investment success, what kind of returns they aim for, their history of complaints. He stressed that the relationship really needs to be mutual, built on competence and trust, not just blind faith.
And looking at the bigger picture, the market itself, Graham saw these repeating historical patterns, didn't he?
Yes, absolutely. He noted the consistent cycles of IPO booms followed by busts, going all the way back to 1825. The public gets excited about some new thing, rushes in, often gets burned, vows never again.
And then comes back for the next hot trend.
Exactly. But crucially, he also pointed out that those market panics and sharp downturns, while definitely scary, can create fantastic buying opportunities in fundamentally sound companies that get dragged down with everything else. He used the Ball Corporation versus Stryker example from the 2002 downturn to show how a panic could depress the price of a good company.
So for the intelligent investor, panic isn't just a threat. It can actually be an opportunity, but only if you've done your homework beforehand.
Precisely. It's Mr. Market having one of his manic depressive episodes and offering you those 60-cent dollars again. But you need the discipline, the analysis, and importantly, the available cash to actually take advantage when those opportunities arise.
Let's pull out a few more really pointed lessons from those historical examples and the appendices in the book. They really hammer home Graham's points, like the Penn Central bankruptcy. That must have been huge.
It was a massive shockwave in 1970. Here you had this giant railroad company, a blue chip, paid dividends for over 120 years, and suddenly it went bankrupt.
Wow.
It was a stark reminder that even the most established, seemingly invincible companies require continuous analysis. A great past history and a solid reputation, while nice, are simply not enough. You have to understand the current business reality and its financial health.
And those accounting games we touched on, it sounds like you really need to be a detective sometimes.
They kind of do, or at least be very skeptical. They can make it incredibly difficult to see the true economic picture. Beyond just the special charges and depreciation methods, understanding how companies account for things like executive stock options or the real impact of potential dilution from convertible securities is absolutely essential to figuring out the real earnings power and the overall financial health of the business.
The comparison pairs Graham used are also quite powerful for illustrating how irrational the market can be.
They really are. They vividly highlight how market prices can be driven by emotion, by glamour, by simple name association, rather than by underlying business value. You had pairs like McGraw-Edison versus McGraw-Hill, where the market seemed to favor the perceived glamour of publishing over the solid, maybe less exciting fundamentals of the industrial company.
Right.
The National General example was fascinating, too. It showed how the existence of warrants options to buy stock at a certain price could completely distort the perception of the common stock's price. You had to account for those warrants to see the true, much higher market valuation the company commanded.
And the Cisco versus Cisco one is almost, well, comical in illustrating that point about glamour.
It really is. Cisco Systems, the high-flying tech giant symbolizing the internet future, versus Cisco Corporation, the food service distributor with images of, delivery trucks and school lunches.
Not quite as exciting.
Not visually, no, but often a cold, hard look at the underlying businesses and their financials showed that Cisco was arguably a more consistent, fundamentally sound operation at the price it was trading for, compared to Cisco's often stratospheric valuation. emotion versus analysis.
And then there was that 3Com spin-off during the height of the dot-com madness.
Oh, that's an absolute classic example of market absurdity. After 3Com spun off its Palm subsidiary, the market frenzy was such that the value assigned to the newly independent Palm shares alone was so high, it implied that 3Com's entire remaining, quite substantial business was worth less than nothing like negative $22 billion.
That's just mathematically insane.
Pure irrational mania. But it also created this bizarre, glaring opportunity for anyone who was willing to see the numbers clearly and act rationally against the herd.
Finally, let's touch on the super investors of Graham and Doddsville Appendix. This feels like crucial evidence for his whole framework, doesn't it?
Absolutely critical. It was compiled by Warren Buffett himself, and it provided concrete, real-world proof that the value investing framework Graham taught actually worked over long periods. It showed investors like Buffett, Charlie Munger, Bill Ruane, Rick Guerin, they achieved consistently superior results.
And they weren't doing it by timing the market or predicting macro trends.
No, not at all. They were focused on buying businesses, understanding the business at a significant discount to their calculated intrinsic value. That was the common thread.
And they weren't overly concerned with beta, that measure of stock price volatility you hear about constantly in finance classes.
No, not in the way modern finance often uses it as the measure of risk. The super investors implicitly rejected that. They showed that buying a wonderful business like the Washington Post back in 1973, when the market valued the whole company at maybe $80 million, while its underlying assets were conservatively worth over $400 million. That was less risky, fundamentally, than buying it at a much higher price, even if the stock price was volatile at that $80 million level, making its beta look high.
So risk for them was about the business, not the stock's wiggles.
Exactly. Risk was the probability of losing permanent capital on the underlying business, not just temporary price fluctuations. These investors, they had different styles. Some were very concentrated like Buffett, others more diversified, but they all shared Graham's core principle of buying value with a margin of safety. And just as importantly, they shared his essential temperament: patience, discipline, rationality.
Okay, that connects back perfectly to the beginning. It also brings us to the relationship between the intelligent investor, thinking like an owner, and the management of the companies they actually own. Graham seems quite critical here at times.
He is, yeah. He wasn't shy at all about critiquing management practices that he saw as harmful or unfair to the average outside shareholders, people like you and me.
What kind of things?
Well, things like hoarding enormous amounts of excess cash on the balance sheet instead of returning it to shareholders via dividends. He pointed to examples like Microsoft, Oracle, Cisco at certain times, sitting on billions and billions. His argument was, as long as that cash stays trapped inside the company, the average shareholder gets very little direct benefit from it.
He also hit on bad acquisitions.
Definitely. Critiquing value-destroying acquisitions was a common theme. He often cited studies showing that many large mergers actually reduced the wealth of the acquiring company shareholders due to overpayment or poor integration that winners curse again.
What about stock buybacks? They seem incredibly common today, even more than dividends sometimes.
Graham noted this trend too, and the commentary highlights it further. Management often prefers buybacks over dividends. Why? Well, partly because executive compensation is frequently tied heavily to the stock price through stock options.
So buybacks can help boost the stock price, which benefits management's options.
Exactly. It creates an incentive for management to use corporate cash to prop up the stock price, even if buying back shares when they're overvalued is actually a poor use of shareholder capital compared to, say, investing in the business or paying a dividend. He also noted that options themselves can incentivize management to pursue strategies that increase price volatility, which benefits option holders more than stable long-term owners.
And what about the role of shareholders themselves? Many investors just seem passive. They don't really engage with the companies they own parts of.
He definitely points that out. Many individual investors completely neglect a fundamental right and responsibility of ownership: voting their proxies. The commentary mentions that roughly a third of individual investors just don't bother to vote.
That's a huge missed opportunity to have a voice.
It really is. Graham believes you, as an owner, should actively judge management.
How?
By comparing their efficiency and results against their peers, and critically assessing how well they treat the average outside shareholders. Are they transparent? Are they acting in your best interests?
And if the results are poor?
If results are consistently poor, Graham argued, it often requires large, substantial stockholders to step up and push for change. But it also requires informed rank-and-file shareholders who are willing to actually weigh the arguments and vote their shares accordingly. Sometimes, he suggested, outside independent reviews might be necessary. He always stressed checking for potential conflicts of interest, especially around executive compensation and any transactions between the company and related parties, citing the Enron disaster as a stark warning. Read that proxy statement.
Okay. We've covered a lot of ground, from mindset to principles to strategy to history. So, what does this all really boil down to for you listening right now? How do we translate this timeless wisdom from Graham into action today?
I think it means recognizing first and foremost that being an intelligent investor is less about having some secret formula or amazing predictive ability and much more about making conscious choices. It requires actively cultivating that character. Graham identified the discipline to stick to your principles even when it's uncomfortable.
Especially when it's uncomfortable.
Right. The patience to wait for the right opportunities, and crucially, the emotional control to avoid getting swept up in the market's inevitable fads and panics.
It's really about shifting your focus, isn't it? Away from the noisy, volatile daily prices and onto the underlying value of the business, and always, always demanding that margin of safety in every single purchase you make.
Mm-hmm. It's about viewing yourself as a discerning part owner of actual businesses, not just a temporary holder of flickering stock symbols on a screen. It's about learning to use Mr. Market's mood, swings his irrational optimism and pessimism to your advantage, or sometimes just having the strength to tune him out completely.
This deep dive, hopefully, has given you the foundational toolkit from Graham's indispensable work. These are principles that have proven robust across wildly different market environments, from the frauds of 1919 through world wars, inflation, deflation, the manias of the dot-com era, and right up to today.
They really are timeless.
So, here is a thought to maybe leave you with. In a world that is still very much prone to those cycles of enthusiasm and despair that Graham describes so well, and where information and disinformation can be overwhelming, where might today's market be offering those 60-cent dollars?
Yeah, where are solid businesses potentially being overlooked simply because they lack current glamour or aren't part of the hot narrative? Where are the opportunities hidden in plain sight, just waiting for the truly intelligent investor guided by character, discipline, and Graham's principles to find them?